Good morning, good afternoon to everyone joining. Welcome to this webinar on exploring 1031 exchange options in farmland. We're going to give folks just a minute or two to join, so we will get started shortly. We expect to start within the next minute. Thank you. Okay, we're going to kick things off here. Thanks again for joining, everyone. I'm very excited for this discussion and to present a educational partnership webinar today with our friends at Affiliated 1031. My name is David Chan. I'm the Chief Client Officer at Farm Together. I'm joined today by Stephen Gurian, who is a partner at Affiliated 1031. Affiliated 1031 is a qualified intermediary. We'll learn more about qualified intermediaries and their role in facilitating 1031 exchanges throughout this webinar. Prior to joining Affiliated 1031, Stephen was a partner at a law firm focused both on tax and estate planning law. So we are going to go ahead and pause on this disclaimer slide here momentarily. We do record this webinar. We will be sharing a recording after the webinar and certainly encourage you to read this more carefully then. We don't expect folks to speed read this now in the moment that we're giving you, but I will pause here just shortly. Okay, let's move on. So our agenda today, we are going to be covering an overview of farmland as an asset class. I know that there's a broad group on this call, some investors who are very familiar with farmland as an asset class and others who are brand new to farmland. So we will be doing a very high-level overview on the asset class. And then we're going to talk about the introduction to 1031 exchanges. So what are 1031 exchanges? Again, broad spectrum of understanding there. For some folks, these are totally new terms. Others, you may have done 1031 exchanges before in real estate, so this might be very familiar for you. And then we're going to transition into an overview of Farm Together's investment products that are eligible for 1031 exchange, as well as a live opportunity that we just launched a couple of days ago that is eligible for 1031 exchange. And then we'll pass it off to Stephen to share a bit more from the qualified intermediary or QI perspective on important facts, important considerations to keep in mind if you are currently in a 1031 exchange or if you are considering one and considering selling an investment property in the future. Just some important factors to think about and just to make the process smoother and hopefully easier for you. So after we go through those 5 sections, we will open it up for Q&A and we'll take questions from the audience. So about Farm Together. Farm Together, for those of you who are new to us, we are a tech-enabled farmland investment manager. We invest in U.S. farmland, and we serve both retail investors and institutional investors. We primarily focus in high-value permanent crops, typically grown on the western half of the United States. So as we'll see in a moment here, our portfolio is concentrated west of the Mississippi, and we also have a pretty decent diversification of commodities as well. So we were founded in 2017. We manage north of 189 million in farmland real estate. That's across a portfolio of 48 properties. And again, looking at our portfolio, generally most of our properties are west of the Mississippi, with the majority being along the West Coast from Washington State down through California, as well as properties in Idaho, Colorado, Nebraska, Oklahoma, and Illinois. Our properties are quite diverse in what what commodities are grown there. So you can see some examples of these commodities below. We have both annual commodities like corn, soybean, wheat. Annual crops or row crops are essentially commodities that are replanted every year. So it's just bare land. There is no long-lived asset like a tree or a vine that is producing commodities on a recurring basis. The permanent cropland that we mentioned that we focus a bit more on is the opposite of that. So in permanent cropland, we do have long-lived assets. Those long-lived assets are actually eligible for depreciation, so there can be depreciable value, and we see that more often than not in our permanent deals. And those are long-lived assets like trees or vines that we're underwriting economic cash flows for a series of years, and typically these can be expected to generate cash flow for a couple of decades. Obviously, that's going to depend on what the commodity and the region is, but generally speaking, economic life of many of these different permanent crops can be north of 30 years or even 40 years. So these are very long-lived assets, and one of the benefits of this asset class is how much productivity and how much cash flow you can generate over a long duration when you make an investment in a permanent property. So shifting gears to farmland performance, again, for those who are new to this asset class, farmland has historically been a very strong asset class for capital preservation. It's been a resilient asset class. Our average annual return that we see for farmland has been around 10.5% with a volatility of 6.6%. So on a Sharpe ratio basis, very competitive across and compared to mainstream asset classes like public equities, bonds, and even traditional real estate. Farmland is also positively correlated with CPI. And so historically, farmland has been a suitable inflation hedge. And if you just think about inflation and what goes into CPI, agricultural commodities go into so many products, not just our food or fuel. They're also used in so many different consumer goods and durable products. So intuitively, it makes sense to me why we do see this positive correlation between farmland and inflation or CPI. And it's something that has shown historically. We do note for anyone interested in the footnotes here, which indices or benchmarks we're using as the basis for all these different asset class comparisons. So if you're curious what we're referencing as equities for this timeline of 1992 to 2023, you can find that in the footnote here. Oh, sorry about that. I think I was on the wrong slide. There we go. And again, we will share this recording afterwards. So if you want to take a look at this data more carefully, you will have access to this. Shifting gears to looking at the diversification aspect of farmland. So another benefit of the asset class is that it is historically shown to be well diversified, particularly in periods of economic headwinds. And so we see a negative correlation between farmland and some large mainstream asset classes like public equities and government bonds. And so in years where these mainstream asset classes, the majority of most portfolios are struggling, farmland typically can buck that trend and produce a positive return. And I think a good just recent example of this was actually 2022, where it was a very tough year for markets. I believe the S&P may have been down around 18% that year, bonds 14% down. And we saw the NAPRE Farmland Index, which we use as our industry benchmark, actually post a positive return. So that is one of the benefits of farmland. It does tend to be very uncorrelated to other mainstream asset classes and can be a great addition to an investor's portfolio from a diversification angle. And then one more slide here on looking at farmland performance over different periods of time. So here we're looking from 1992 to 2023, and we actually have a couple of different mini periods that we picked out of economic disruption in the US. And a couple of those periods are the dot-com bubble, the great financial crisis, and then most recently, COVID and the pandemic. And what you can see here is farmland, again, generally is a very gradual increase. We don't experience huge jumps. We don't expect to see huge jumps from year to year, but we also have not historically seen huge declines from year to year. So it's historically behaved very consistently and shown gradual increase even in periods of otherwise economic turmoil or headwinds for other asset classes. So now turning the page to the 1031 exchange conversation. So 1031 exchanges, for investors who have never heard this term before, the name comes from the Internal Revenue Code, or the IRC code section 1031, which essentially is the legislation that covers what a 1031 exchange is and what are the requirements for being able to leverage a 1031 exchange. So essentially what an exchange is a swap of one real property with a like-kind investment, or an investment in a real property interest of another 1031 eligible opportunity. So like-kind assets can include residential real estate, which would of course include multifamily, commercial real estate, or other land use investments. And so this third category here is where farmland would fall. And what I often hear from investors who are considering a 1031 exchange is that they were not aware that farmland it falls under the like-kind definition, or can be considered as a 1031 eligible option. And so we've helped investors who have sold commercial real estate properties, gas stations in one state, and they've replaced those properties with a hazelnut orchard in another state. So you can swap, and your relinquished property, which is essentially the property that you're selling, can be in a different geography and obviously for a very different use than what your replacement property, the property that you were investing into through the exchange, is designated to cover. There are many considerations and potential benefits for looking to take advantage of a 1031 exchange. And Stephen will cover many of these during his portion of today's webinar. But some of these include the deference of the realization of capital gains. And so if you were to sell a investment property outright and not take advantage of a 1031 exchange, and you were recorded or realized a gain on that sale, you would likely have some form of a tax liability. The 1031 exchange program allows you to defer the realization of capital gains through the exchange. There's also benefits around depreciation, recapture, and other federal tax liability efficiencies as well. So there are many financial considerations for looking to take advantage of a 1031 exchange. There's some non-financial as well, thinking about estate planning, thinking about how to look at a long-term duration hold of real estate. If you are looking to take advantage of this program, considering the hold period of your replacement option and how often if you do intend to roll the investment over subsequent 1031 exchanges, how many exchanges you'll need to do in a given period of time in order to do so. Those are all considerations as well. Coming back to the financial considerations, so just a quick example here of a potential benefit of a 1031 exchange. So for this example, we used the projections for a prior farm together investment opportunity, Galaxy Organic Apple Orchard. So I do want to just note that these are projected returns. So these are not realized. This is a live offering that is still currently managed by Farm Together. But based on our underwriting of this property, these are the potential returns that we believe would be possible for an investor leveraging a 1031 exchange. So if a hypothetical investor purchased an investment property in, say 1990, for $500,000 and is now in contract to sell that property for $1 million, they would essentially have a long-term capital gain and a federal tax liability of approximately $100,000, assuming a 20% long-term capital gain tax. By leveraging the 1031 exchange, this investor could defer this capital gain tax, and they would do so by investing in a like-kind investment opportunity. So if they were to be we'll learn about a product momentarily called a tenancy in common, or a TIC investment. If they were to be a TIC investor in Farm Together's Galaxy Organic Apple Orchard, the comparison here would be potentially an outflow of $100,000 to meet that tax liability from the cash sale, or potentially generating almost $114,000 of income and just south of $200,000 from net proceeds of sale through the Galaxy Organic Apple Orchard investment opportunity at Farm Together. So the potential tax savings here are north of $300,000 by leveraging that program, leveraging the tenancy in common investment product and going through a 1031 exchange rather than realizing the potential cash tax here of the sale. So that is obviously a financial consideration. As I mentioned, there are other considerations as well, which Stephen will cover, but certainly that is probably the biggest and the one that most 1031 investors ask us questions about and are interested in. So in Farmland, when we look to facilitate a 1031 exchange, and the process would probably be exactly the same in any other real property asset class, upon the sale of a relinquished property, Farm Together would provide an investor with preliminary replacement recommendations, or what we call PIRs. For us, PIRs are essentially our investment thesis on why we have a particular property in our pipeline and why we're excited about that deal, and why we would recommend that property for investment. Investors would then evaluate those different options and let us know which options they were most interested in. And this typically would need to occur within a 45-day period. So assuming you close your sale on call it January 1st, you would have 45 days from January 1st to identify up to 3 properties that you would potentially be looking to replace your sale proceeds from through the 1031 exchange program. Once that 45-day period has ended, you're locked into those replacement options. So those options are the options that you would need to move forward with if you wanted to complete your 1031 exchange. The exchange would need to be concluded within a 180-day period. So roughly 6 months after, again, our example here is January 1st. So by June 30th, you would need to actually close on the purchase of your replacement property. And we would work with a qualified intermediary like Stephen and a group like Affiliate 1031 during this period to help facilitate the exchange. For Farm Together, we have 2 products that are eligible for 1031 exchange, the tenancy in common product and sole ownership or bespoke offerings. Tenancy in common or TIC offerings are essentially partial ownership of real property. And so they have a lower minimum. So we're able to offer those investment products to investors at a lower minimum than what a sole offering or bespoke offering would be, which would be a sole ownership of a property. Our minimum investment for our TIC product is $500,000. Our minimum investment for a bespoke product is $3 million. The typical hold period for our TIC product is 8 to 12 years. For sole ownership, it's a customized hold period, so the investor can use their preference and discretion to define the hold period there. And the typical return profile that we're targeting for our TIC products would be a 6 to 13% net IRR and a 2 to 9% target average net cash yield. Those are large ranges, but we do see a very good mix of different deal structures, ranging from deals that generate income through rent and others that generate income through operating income, as well as development deals versus turnkey opportunities. So that is why that's a large range there. And then finally, I mentioned that there is a live opportunity available. So if there are investors actively in a 1031 identification period now or considering a 1031 sometime this year or in the coming month or so, we do have an opportunity, the Great Valley Citrus Grove property that is a citrus grove located in Fresno, California. We're very excited about this deal. We just closed a citrus grove nearby in Fresno. And it's a great area with a very secure water availability in this water district, the Alta Irrigation District. We have a whole webinar that we recorded that you can learn more information on this particular deal if you are interested on our website. And the projected targeted financials are listed here. For our syndicated offerings, we do typically accommodate tenancy in common or TIC investors. We do limit the number of TIC investors in any particular deal just to manage the deal more effectively and also keep the administrative requirements to a minimum for TIC investors. And so generally speaking, if you were interested in leveraging a 1031 through one of our syndicated offerings, we would ask that you let us know around the time of launch so we can assure an allocation of a TIC interest for you. We do still have limited availability for TIC investors in this offering. So if there is interest for anyone on the call for a TIC interest in Great Valley, I think we could probably accommodate a couple more TIC investors in this particular deal. But we also will have many more syndicated deals throughout the rest of the year. So feel free to explore other deals in the future as well. But we do ask that you do let us know early on in the launch sequence of any syndicated offering that you are interested in a TIC, just so that we can ensure an allocation. With that, I will turn it over to Stephen to cover more aspects of the 1031 exchange process and more about affiliated 1031.
Thank you, David. That was some awesome information. So yeah, again, I'm Stephen Gurian, and I'm one of the principals of affiliated 1031. So let's talk a little bit about some of the basics of doing a 1031 exchange, what the role of a QI is, and exactly what goes on in a 1031 exchange. So this is our team at affiliated 1031. We are attorney owned and operated. So there are no non-attorneys that own affiliated 1031. So you can actually go on to the next slide. We don't have to look at me too much there. So we talked a little bit about already, or David rather talked a little bit about already, like what is eligible like-kind property. So essentially, as long as it's real estate or some form of ownership in real estate, you could 1031 in and out of those types of properties. However, there are certain, properties that are, personal properties or intellectual properties, things like that, interest in companies that are ineligible for like-kind treatment. So the first one is partnership interest. So your partnership interest in a limited partnership or an LLC is not eligible for like-kind treatment, even if that partnership owns a piece of real estate. Only the real estate itself is eligible for like-kind treatment under Section 1031. Next one is stock in a trade or business. That is also ineligible for 1031 treatment. Again, even if the C Corp or S Corp owned an interest in real estate. So stocks, bonds, notes, things like that. Mortgages, they're ineligible for like-kind treatment. Certificates of trust are ineligible. Securities or evidence of indebtedness, again, not eligible for like-kind treatment. Your primary residence is a big one, and a very big misconception out there. There's a lot of people think, hey, I could 1031 my primary residence. And that actually couldn't be further from the truth. So your primary residence is not eligible for 1031 treatment. 1031 only applies for investment property, and you have to sell investment property and acquire investment property to qualify for 1031 treatment. That is to say, though, your primary residence can become an investment property, and eventually you can do a 1031 with what used to be your primary residence after it's been an investment property for at least a year and a day. IRS likes to see you do a 1031 if you've owned investment real estate for 2 years. But there is some case law out there that says that you can't do it if it's a year and a day, because you're able to show that you're an investor as opposed to, fix and flip person or a dealer is what the IRS likes to say with respect to that. If you go to the next slide. So let's talk a little bit about some of the potential benefits of doing a 1031 exchange. So let's say you want to diversify your asset class. You absolutely can. You could sell one property. You're going to identify potentially up to 3 replacement properties, and you could buy 1, 2, or all 3 of those properties that you identified. So you could mix and match different asset classes to your portfolio. You could also consolidate. Let's say you're sick and tired of being a landlord, or you just want to reduce the amount of investment real estate that you have. You could sell 3 pieces of real estate and 1031 into one. So the opposite is true. So typically people sell 1, potentially buy 3. You could sell 3 and buy 1 by consolidating your real estate portfolio. Obviously, cash flow is a big one. If for whatever reason you decide to sell 1 property and potentially buy 3, you're going to increase your cash flow by having additional rental properties at your disposal in your portfolio. And management relief, kind of talked about it already. When you're consolidating, if you're trying to reduce your portfolio, 1031 is a great tool to defer capital gains taxes if you're looking to potentially purchase a replacement property, one replacement property while selling, 2, 3 or more relinquished properties. Increased depreciation. That's another huge advantage of doing a 1031 exchange. So you're deferring your capital gains taxes, you're deferring your depreciation recapture taxes that we alluded to earlier. But also another thing you're going to defer is your state income tax. So if you live in a state where you have state income tax, you're able to defer all 3 of those taxes. And again, if you're taking depreciation on your properties, you're able to depreciate all across the board of your replacement property. So that's a huge advantage. And then finally, estate planning. We kid around in the office and we say you get to defer till death if you do multiple 1031 exchanges. So it's possible to continue doing 1031 exchanges for the rest of your life. And there's the potential to defer those capital gains taxes, depreciation recapture taxes, throughout the life of your 1031 cycles. And then if, something happens to you, your heirs get what's called a step up in basis in those assets, in those capital assets. So basis is just a fancy term that the IRS gives for what your capital expenditure or what your capital cost was when you purchase your investment property. So if your basis was 100 and you sell for 500, we know that we have a $400 capital gain, $400 capital gain. If you do 1031 exchanges, your basis remains at $100, but if you keep doing them over and over again, whatever that fair market value is of your investment real estate, that's going to be the new basis for your children or your spouse when you do a transfer of those assets, maybe through a trust or something of that sort. And there's the potential to eliminate capital gains taxes by incorporating 1031 exchanges into your estate plan. We go to the next slide. So we mentioned it a little bit. So what is the exchange process like? So we as a QI, what we do is we facilitate the exchange. So we're just another party that shows up at the closing table, and we prepare the exchange documents. So you have an exchange agreement between the buyer and seller, just letting them know that, hey, we're taking part of a 1031 exchange, and we as QY have to hold on to the funds when your relinquished property is sold. Otherwise, it completely disqualifies the sale from getting 1031 treatment. So the exchanger, the seller, can never at any point in time hold on to the funds from the sale of the relinquished property. That's where we come in. So again, in addition to drafting the documents necessary to facilitate the exchange, we actually hold on to the money during that, potentially 180-day timeline when you're doing your 1031 exchange. So those proceeds are delivered to us. On the date of closing, you have 45 days to identify up to 3 properties that you would like to purchase to complete your 1031 exchange. You can swap them out at any point in time during that 45-day period. So, if you send me an email and say, hey, Steven, I've identified, 123 Main Street as a potential replacement property, a couple of days down the line, you could say, you know what, I've changed my mind. I want to do 456 Cherry Street. And you absolutely can. So you could identify up to 3. You can mix and match them as many times as you like during that 45-day period. But as soon as midnight hits of day 45, you're stuck with whatever it is that you've identified. And then you have to close on at least one of those properties to complete your 1031 exchange. We could go to the next slide. So let's talk a little bit about the 180-day rule. So we know that there's 2 timelines, right, from the date of closing. So you've got your 45-day timeline, which we just talked about, and simultaneously you have the 180-day timeline. A lot of people think that the 180-day timeline runs when the 45-day period expires, but that actually isn't the case. Both of them run concurrently from the date of the sale of your relinquished property. And there's no extensions of either of these timelines. The only time these timelines ever get extended is by an act of the President of the United States. Typically, what winds up happening is, there's some sort of natural disaster, and it affects, closings of real estate. So the president, if you wanted to, could actually extend these timelines, and it's happened before. I'm in Florida, and it happens quite often with the hurricanes. If a hurricane hits the state of Florida, Typically, there's an extension of those timelines if the replacement or relinquished property are located in that disaster area, or your QI is located in that disaster area. So again, these deadlines are hard and fast, can only be extended by the president. Even if it falls on a weekend or legal holiday, you have to close or identify by that date. So a lot of people may think, oh, if it falls on a Sunday, the deadline is really the following Monday, and that really isn't the case. You got to identify by that date, even if it's on a weekend or legal holiday. We can go to the next slide. So how do you pick a QI? There's a couple of factors you should definitely look into. So security, service, the experience of the QI, the price, and obviously, the legal team associated with the QI. So obviously, this requires a lot of faith, right? You're putting your money in someone else's hands, and potentially it's going to be there for 180 days. So you want to make sure that the money is safe. It's in an FDIC insured account. Even better if there's a CIS associated with those funds where they could potentially be insured to up to $50 million. That's something you want to look out for. Service is another one. You want to be able to call your QI and speak to the QI. You don't want to speak to a legal assistant or some sort of secretary. You want to make sure that, if you have a complicated exchange, that you're able to speak to the QI directly, whether, it's an attorney or an accountant or somebody experienced in the field. And again, experience, that's another thing. You want to make sure your QI has been doing this for a really long time. Sometimes you have very simple forward exchanges or simultaneous exchanges, but you may do something like a reverse exchange where you could actually purchase your property before you sell. And that requires a great deal of experience to make sure that the closing occurs on time and everything is done right. Obviously, price. You want to make sure that your QI charges what's ordinary and customary in the market. You want to be sure to look out at the amount of the exchange fee, and you want to make sure there's no hidden costs. A lot of QIs, they charge on a per transaction basis. So when you sell a property, there's a charge. And then when you purchase a replacement property, there's another charge. Every QI is different. Some charge only one-time fees. But again, I would say it's pretty customary for most QIs to charge on a per transaction basis. And then obviously you want to make sure that every transaction is reviewed and overseen by an attorney or some sort of tax expert to comply with Code Section 1031, as well as the regulations for Code Section 1031 before it's submitted to the IRS when you report your 1031 transaction. That's essentially it. Those are the things you definitely should look out for in selecting a QI. You could go to the next slide. And that's it. If you ever have any questions regarding a 1031 exchange, feel free to call us. More than happy to answer anything you may have.
Thanks so much, Stephen. Great thoughts there, and really appreciate all of your perspective on the process. So thanks everyone for joining and staying with us to cover this very interesting topic. I think 1031 exchanges, when I first learned about them, I was sort of amazed, and I still think that they're such an interesting opportunity for investors who do have investment property in real property, and could be a very powerful tool for estate planning. So we're happy to be able to play a role in helping investors evaluate options for potential replacement properties. With this, I think we could now open it up to Q&A. And so I've seen several questions come through already, and we will try to cover those questions and obviously be respectful of everyone's time here. So let's jump right into those. And many of the ones I saw, Stephen, I think are perfectly suited for you. So I'm going to be passing a lot of these over to you. But the first one here is, during the 45-day identification period, are you able to change the properties you have already identified? So if you identify 3 properties, again, going back to our hypothetical January 1st sale date, if you identify 3 properties on, say, January 5th, and then on January 31st, you change your mind and you want to switch out some of those properties, or maybe all 3 of those, can you do that if you're still within that window?
Absolutely. So as long as you're in that 45-day window, you could swap out the properties as much as you like. Your QI might hate you because you're making them do extra work, but you absolutely can change those properties out. Again, once midnight hits on day 45 and we're into day 46, you're stuck with what you have. So you get what you get and you don't get upset.
Excellent, thank you. And another just follow on here that I've seen from the manager perspective, but sometimes investors will ask what is needed for making that identification. You know, what makes it official essentially. So that might vary from QI to QI, but generally what we have seen through our tech investors and our 1031 investors is typically the main piece of information that's needed is the APN or the property identifier for the replacement property. Is there, and I think sometimes the legal description of the property, but is there anything else that you typically see as a requirement, or what does affiliate 1031 require as sort of the information to count a property as a replacement?
Sure. So when you're identifying something, you really just have to give the property address or the legal or the tax folio number. The APN is, I guess, what you guys call it. When we put our documents together, we actually put all three just to cover our bases. But really, all you need is something in writing. It could even be as simple as an email, just stating that, hey, I'm identifying this property for my 1031 exchange.
Got it. Thank you. We covered this, but I always think it's a fun question. Another question around the timelines. So have there been any, or are there extensions? Have there been any extensions to the 45-day and 180-day timelines? And I know you had mentioned that can be moved because of executive order. So the president would need to essentially issue such an order to extend the timelines. But I do remember, and I think this would fall under the category of, sort of natural disasters or or other phenomena. I do recall, I believe during the pandemic, seeing extensions occur. So just based on your history of working in the 1031 exchange space, could you give us a couple of examples of the few times you may have seen any extensions actually occur?
Sure. Actually, I mean, being in Miami, we get them all the time. So last year, I forgot the name of the hurricane, but one hit the Panhandle, and basically the Panhandle of Florida was the entire disaster area. So if buyer, seller, QI, or the property was located in that disaster area, you got an extension of both the 45-day and 180-day timelines. When Hurricane Ian hit Miami, I think in 2022, we got an extension. The whole state of Florida actually had gotten an extension of the 45 and 180-day. I think there was an earthquake in Illinois a couple of years ago too. I remember them getting an extension of both the 45 and 180-day timelines. It happens quite often. It just really depends on where you live, because obviously it wouldn't be a national extension except for the case of the pandemic, but it's typically, acts of God, things like that are when an extension is warranted and given by the President of the United States.
And what happens if I'm sure this happens all the time, day 45 or day 180 falls on a weekend or a bank holiday? What is typically the standard convention there?
So you still got to identify by that date, even though it falls on a weekend or legal holiday. Again, you don't need to do anything fancy. You could just send me an email identifying the legal description or tax folio number or physical address of the property, and that's sufficient for identification purposes. And then for the 180-day timeline, you got to close. It doesn't matter if that 180th day lands on a weekend or legal holiday. I guess you just got to close the Friday before, or have a really good closing attorney that's got no problem doing all that paperwork on a weekend.
Thanks. All right, there's one here or two here I'll address. So one is a very specific question. An investor is asking if they are a resident of a state, California in this case, and they were to go through a 1031 exchange and then move out of the state in a later year, when that replacement property is eventually sold, would the exchange property be responsible for state taxes in the new state of residence or California where the exchange was originally executed? Go ahead, Stephen.
So I hate to give you the lawyer answer, but it depends. So typically you're reporting taxes on the date that the exchange occurred. So if you happen to move out of the state in a later year, you're going to be a California resident for the purposes of that tax return. Now, if you let's say you did your exchange January 1st of 2024, lived in California for 5 months, and then you moved to Florida, and you're there for 7 months, then for that purpose, you're in the state of Florida more than 180 days. So you could classify yourself as a Florida resident, and presumably you wouldn't owe any state income tax in the state of California, because you're now a Florida resident. Definitely check with your CPA on that, because it really depends, how long you're in one state versus the other, what taxes you're paying, what it is that you're filing.
Thanks, Stephen. That was helpful. And then another one here that I can cover. It's a Farm Together specific question. So how do we ensure additional TIC investors do not dilute projected returns for existing investors who are already part owners? So TIC investors would not dilute returns for other investors, be it TIC or syndicated crowdfunded investors. We do not accept new investors into a previously syndicated or closed offering. So it's a pie chart of equity, and once that equity is spoken for, it's spoken for. And so a TIC investor is being allocated the same amount of equity for a property for their equity dollar contribution as a syndicated or crowdfunded investor would be. And that ownership interest is going to be what essentially controls all future distributions, be it of income, allocating depreciation value, net proceeds from sale at the end of the whole period. So that ownership interest does not change. There's only 100% of equity in the deal. It never becomes 99%, never becomes 101%. So dilution would not occur here, and TIC investors would be part of the original ownership group at the time that we closed the property. Okay, another question here on whether or not international investors can do a 1031 exchange.
So yeah, non-resident aliens can do 1031 exchanges. There's no prohibition on foreigners doing 1031 exchanges. They just have to comply with something called FIRPTA. So essentially what winds up happening with these foreign investors is that when they're selling the replacement property, there has to be a withholding of 15% of the gross sales price of their relinquished property, which has to be remitted to the IRS. Now that may, in some minds, defeat the whole purpose of the 1031, because your QI isn't holding on to that 15%, but there's certain forms you can file with the IRS to let them know that you're doing a 1031 exchange, and basically get yourself to the finish line if you are a foreigner doing a 1031 exchange. So bottom line is, foreigners can do 1031 exchanges. They just have a couple of hurdles they have to jump over, but it can be done.
A question here on whether there are different types of 1031 exchanges. So we don't have time to cover the different flavors, but there are different types of exchanges. There are delayed exchanges, reverse exchanges, simultaneous exchanges, and improvement exchanges. If you have a specific question on any of those particular forms of exchange, please feel free to reach out. Essentially, I think one of the biggest distinctions between these different forms of exchanges is essentially the timeline of what occurs. So most common, we see investors who have sold or are in contract to sell an investment property, and they're looking for replacement options. Sometimes the order of that is reversed, and so investors find a investment property that they are looking to enter into, so it's effectively becoming the replacement property, and they sell their relinquished property at a later date. So that is one wrinkle there that we see that causes a different form of exchange. There are still time requirements on those different forms of exchange as well. But again, too much to cover in the limited time that we have. So if you do have a question on one of those other types of exchanges, please feel free to reach out to myself or Stephen, and we can certainly give you additional thoughts and guidance there. Here's a question on how the exchange is reported to the IRS. So Stephen, maybe you can talk about Form 8824.
Sure. So when you're doing your 1040 every year, You're going to be filing that form in conjunction with your 1040. You're just going to let the IRS know that you sold your relinquished property, and then you purchased a replacement property. You're going to furnish your closing statement. You're going to furnish the documents that we as qualified intermediary prepare to facilitate the exchange. And then that's how you're going to properly document your 1031 exchange with the IRS so that you're not, paying tax when you're not supposed to.
Thanks, appreciate that. We did cover this already. Can you do a 1031 exchange on a primary residence? No, but as Stephen mentioned, a primary residence could turn into an investment property, which could later potentially qualify for 1031 treatment. But the simple answer is generally, I think for most folks, no, unless the classification changes there. Maybe one, we're sort of running out of time here. Maybe one last thing that we covered briefly. I know we covered portions of this, but the restrictions on the replacement property. So we talked about the 3 property rule. Maybe we could just go over the 200% rule and the 95% exception rule briefly for investors who are considering 1031s, just to be aware of those other requirements.
Of course, so the 3 property rules probably the most common, but yes, there is the 200% rule and 95% rule. So essentially with the 200% rule, you could identify 4 or more properties, but the total fair market value of all the properties that you identify can't exceed 200% of the total value of all your relinquished properties. So what does that mean? Essentially, if you sell for $1 million, you could identify 4 more properties so long as those 4 more properties don't exceed $2 million of value. So that's essentially the 200% rule in a nutshell. And then even far less common is the 95% rule. So you could identify 4 more properties, or replacement properties that is, with no limit on the total fair market value. However, you have to acquire at least 95% of the fair market value of all the properties that you identify. So that isn't 95% of the actual individual properties that you identified. You actually have to acquire the value. So 95% of the value of the properties that you identified.
Perfect. Thank you, Stephen. I think with that, and I recognize we're already a little over what we dedicated for this webinar. I think with that, we can wrap up. So thank you, Stephen, so much for joining us on this webinar. We had a lot of fun discussing 1031s with you and the role of the qualified intermediary with all of our attendees today. I'm just going to go back briefly here to again share Stephen's contact information. So if there are any questions on, again, the role of the qualified intermediary, or if you are interested in learning more about affiliate 1031 services as a qualified intermediary, please feel free to reach out to Stephen here. And if there are any questions for us at Farm Together on investment products or live deals like the Great Valley Citrus Grove opportunity that we referenced a bit earlier in the presentation here, please feel free to reach out to us at Farm Together. We can be reached by email at investments@farmtogether.com. And again, a recording of this will be posted both on our website at Farm Together, and we will also share it with all registrants of the webinar. So with that, again, Stephen, thank you so much. It was a lot of fun joining you today. And I hope everyone has a nice day and a good week.
Thank you so much for having me. It was a pleasure.